Yes guys, so welcome back to our next session. So we are here to discuss about IND AS 38 regarding its illustrations. We did discuss about IND AS 38 in detail. We did cover its recognition criteria, the measurement, the amortization, the research and development expenditure which majorly deals with internally generated assets. We've dealt with all these things. Now it is important for us to deal with the illustrations regarding this standard. Now when we look at illustrations, I'll divide this into three parts. First one, which is your illustrations given in your standard. Number two, the workbook, which is your module number 3. And finally, I'll go with compendium of solved illustrations. In all, we are looking to cover at least 50 illustrations from this standard. Clear? So I think that should give you a better idea of what the standard is and how to implement the standard or how to apply the standard in various cases. Clear? So let's start. Now I'll begin with the illustrations given in the standard, guys. The first illustration given in the standard. Sun Limited has an expertise in conducting business. In the past years, it has gained a market share for its services for 30%. Considering the recognition of intangible asset, is the action by the company justified? So he's saying that he has considerable amount of market share of 30% and wants to recognize this market share as an intangible asset. Now the question is it justified under IND AS 38? The answer is absolutely no. Why is that so? Because though these are definitely giving us from future economic benefits, because you are covering almost 30%, but unfortunately it does not meet the identifiability criteria. Can it be separable? Absolutely not. Because it is a 30% of market share and conducting the business, you can't separate this out of your business and sell this separately or exchange it separately or license it separately. Now, is it combination of inseparable parts of tangible and intangible component? Absolutely no. This is only a synergy effect which is actually appearing. So it is not possible to actually meet the definition of identifiability. And even if it meets the definition of identifiability, it is a self-generated asset for which the cost of the asset cannot be measured reliably. You cannot measure the cost of the asset. Therefore, you have to charge it off to P&L. Clear? So first one, it is not through separate legal rights and there is no tangible and intangible component which are coexisting in this case. Therefore, it does not meet the definition or the recognition criteria of identifiability. The second thing which I am talking about is that it cannot be measured because it is an internally generated asset and the cost of which cannot be reliably estimated. Therefore, it has to be, it is not eligible to be recognized as an intangible asset. Clear? First, and a simple illustration that we started. Look at illustration number 2 then. XYZ has provided training to its staff. Guys, this concept of training to staff you will come across in multiple questions. So this is one more question of such sort on various topics like GST, IND AS, etc. to ensure the compliance with as per the required law. Can the company recognize such cost of staff training as an intangible asset? Guys, this particular illustration is basically derived from an example which we have already seen. A staff training cost, can I recognize it as a separate intangible asset? The answer is no. Why is that so? Because it is very difficult to contain the skill of the employee. Therefore, since the control of the asset cannot be established, you cannot recognize this particular asset as a separate asset. Therefore, the staff training cost is ineligible to be capitalized. However, if I want to capitalize the staff training cost, I need to make sure that certain contracts are in place which are legally enforceable, which will bind the employees to work in the organization for a longer period of time, or even if they intend to leave the organization is entitled to receive certain compensation in this regard. Only in such cases, it is possible for you to capitalize this staff training cost as a separate intangible asset. Look at what is the solution that he is giving. It is clear that the company will obtain economic benefits from the work performed by the staff as it increases their efficiency, but it does not have a control over the staff because they could resign from the company at any point of time. Hence, since the company lacks an ability to restrict access of others to those benefits, the staff training cost does not meet the definition of intangible asset. Like I told you, however, you can enhance this answer by writing a statement saying that if the enterprise XYZ Limited is interested or wants to recognize this as an intangible asset, then there should be legally enforceable contracts in place which will entitle the company to receive a compensation from the employees when they resign from their duty. Clear? Now, are these the first time that we are looking at? Is the solution something which I thought about? Absolutely no. Infosys has its training in the place called as Mysore in Karnataka. Now it's 6 months hardcore training which is provided to any personnel who is recruited by Infosys. Now after the 6 months or during the 6 months, they make you sign a contract saying that if you leave the organization, you are supposed to pay the organization a certain amount. So that is exactly what I'm talking about. Clear? So this is not something new. It has already been there. Look at illustration number 3 then. Pluto intends to open a new retail store in a new location in the next few weeks. Pluto has spent a substantial amount of series of television advertisement to promote its new store. Common. Take the example of there's a jewelry store. There was a jewelry store, I forgot the name. But this jewelry store had a fantastic advertisements which are keep on playing. And there's a bald guy who actually comes up and so much of advertisement is done to promote a new store. The company, it is Lalita Jewelry, correct. The company has paid an amount of 8 lakh rupee for advertisements before 31st March. 7 lakh relates to advertisements shown before 31st March and 1 lakh advertisements shown in April 2011. Since March, the company has paid a further advertisement cost of 4 lakhs. So much of advertisement cost. Look at the amount of advertising cost that he is paying. So he is talking about 8 lakhs plus further 4 lakhs being paid, total 12 lakhs being paid only for advertising services. Pluto is of a view that such costs can be carried forward as intangible asset, since the market research identifies that a new store is likely to be highly successful. Please explain and justify the treatment as per the above cost in the financial statements for the year ended 31st March. Can you call such advertisement expenditure as an intangible asset? First thing, is it identifiable? Is there a separate legal rights that will entitle you to receive an economic benefit from the customers over a period of time? Absolutely no. Even if I run hundreds of advertisements, there is a very well good chance that my customers or the customers may not actually appear to my store. So it is very much possible. There is no separate legal rights out here. Now it cannot be separated and sold. So separability is not met. What about the second one? Is it combined as a tangible and intangible component? No. Therefore, advertisement expenditure does not satisfy the definition of intangible asset and the recognition criteria of the word identifiability. Since it cannot be identified separately, it is not entitled to be capitalized as an intangible asset. Second thing, future economic benefits are uncertain. It is not probable, it is uncertain. Just because I played advertisement does not mean that the customer has to come to the store. Clear? So, in such view, I can say that this expenditure is not entitled to be capitalized. However, as far as 31st March balance sheet date is concerned, I paid 8 lakhs. 7 lakhs relates to the advertisements played before 31st March and 1 lakh to the advertisements which will be shown in April. To the extent of this 1 lakh rupee, which I already paid for the advertisement cost in April, at the end of 31st March, I can call this as prepaid expenditure, not intangible asset. Only a prepaid expenditure can be shown with respect to that 1 lakh rupee of expenditure which has already been paid before 31st March, but the advertisement will be displayed only in the month of April. So what did we conclude? We are saying that this advertisement cost is not an identifiable asset. Therefore, it should not be recognized as an intangible asset as per Ind AS 38. However, 1 lakh rupee which has been already paid before 31st March, but the advertisement being displayed in April of the subsequent year has to be recognized as prepaid expenditure. Read the answer. Under Ind AS 38, intangible asset can only be recognized if they are identifiable and have a cost which can be reliably measured. These criteria are very difficult to satisfy for internally developed intangible asset. For these reasons, Ind AS 38 prohibits recognizing advertisement expenditure as an intangible asset. The issue of how successful the store is likely to affect this prohibition. Therefore, such cost should be recognized as expense. However, the cost should be recognized on accrual basis. Therefore, advertisement of 7 lakhs paid before 31st March is recognized as expense during the period. 1 lakhs is a prepaid expenditure for the subsequent to the year 31st March. 4 lakhs of cost of advertisement for the next year should be charged to P&L for the year ended 31st March 2022. Clear? Look at illustration 4 then. Mercury Limited is preparing its accounts for the year ended 31st March 2022. It is unsure of how the following items should be treated. The company has completed a grand marketing and advertisement campaign for 4.8 lakhs. Financial Director has authorized their campaign on the basis that it would create 8 lakhs of additional profit for the next 3 years. Guys, he is creating a campaign and he is saying that this will generate 8 lakh rupees of additional profit. Guys, just because future economic benefits are probable, you cannot capitalize this expenditure under Ind AS 38 because they are not separately identifiable. A new product has been developed during the year. Expenditure total to 3 lakhs, of which 1.5 lakh has been incurred prior to 30th September, the date on which it has been clear that it is technically viable. The new product will be launched in the next 4 months and has a recoverable amount of 1.4 lakhs. Guys, this is a new product. So that means it is undergoing a stage of research and development. Internally generated intangible asset undergoing the stage of research and development. The total expenditure on both research and development put together is 3 lakhs. However, 1.5 lakhs was incurred out of this 3 lakhs before 30th September. That is the date on which it became clear that the product is technically viable. Guys, technical viability was one of the criteria that we have learned under your Ind AS 38 for capitalizing of development cost. There were 5 points regarding capitalizing development cost. Do you remember them? First one, it should be technically viable. Second one, the enterprise should have an intention and ability to complete the development of the asset. Number 3, sufficient resources to complete the development are available. Today, this has become one of the biggest problem because even when you have created the vaccine, they said that the vaccines cannot be supplied in larger quantity because the raw material for supply of vaccine is related to the US. And US had certain actions which are applied whenever they are trying to supply such kind of raw material. There was diplomacy which happened between both the countries, India and US, and finally US cleared the raw material to Serum Institute. So availability of raw material is one of the major criteria whenever you are capitalizing the development cost. Number 4, future economic benefits are probable to arise from either use or sale of the asset. Last one, cost during the development phase can be reliably measured. We have learned these 5 conditions. Applying one of those 5 conditions, once it has become technically viable, then you can say that it is eligible to be capitalized. So 1.5 lakhs which was incurred prior to the date on which technical viability was established, you have to be charging it to P&L because such expenditure relates to research phase. Such expenditure relates to research phase. Out of 3 lakhs and 1.5 lakhs is charged to P&L. The balance 1.5 lakhs relates to your development phase which is eligible to be capitalized. However, he is saying that the recoverable amount of this asset is only 1.4 lakhs. This concept of recoverable amount, we will learn it in Ind AS 36 when we talk about impairment. Here, intangible asset under Ind AS 38 should be capitalized for 1.5 lakhs. But however, as per Ind AS 36, since your recoverable amount is only 1.4 lakhs, which is a little lower than the capitalized value, the difference between these two should be charged to P&L as impairment loss. What is the impairment loss? 1.5 lakhs minus 1.4 lakhs. That is nothing but 10,000 should be charged off to P&L. Clear? Or 0.1 lakhs should be charged off to P&L. So what is your final answer? 1.5 lakh charged to P&L as research expenditure. 1.5 lakh capitalized as development expenditure as per Ind AS 38. But however, this 10,000 rupees should be charged to P&L as impairment loss since your recoverable amount is less than the carrying value or capitalized value of the asset. Moving on. Staff participated in a training program which cost rupee 5 lakhs. The training of the organization has made a presentation to the directors outlining that the incremental profit to the business over the next 12 months would be 7 lakhs. Whether such amount should be intangible asset as per Ind AS 38? Absolutely no. Staff training cost, you cannot control it. Therefore, it is a skill of the employee which may not be identifiable as well. Even if you want to identify, it is not possible to control. Since it is not possible to control, you will have to charge off the staff training cost of 5 lakhs to P&L. It is ineligible to be capitalized. In all three cases, first one, advertisement campaign, charged to P&L because it is not identifiable. Next one, research and development phase, research expenditure charged to P&L 1.5 lakhs. Development expenditure capitalized 1.5 lakhs. But since the recoverable amount is only 1.4 lakhs, 10,000 should be charged to P&L as impairment loss as per Ind AS 36, not 38, impairment of asset. Staff training cost should be charged to P&L since the enterprise lacks control over this intangible asset created. Look at the treatment. Marketing advertisement cost, no intangible asset is recognized because it is not possible to identify future economic benefits that are attributable only due to this campaign. All the expenditure charged should be charged off to P&L. New product. The development cost, which will be shown in the balance sheet for 1.5 lakhs. The expenditure prior to the date of the product become technically viable should be recognized in the statement of P&L as a research expenditure. He did not take that 1.4 lakhs of recoverable amount into criteria. You can add the answer there. Since the recoverable amount is less than the cost of the asset, so 1.4 lakhs is less than 1.5 lakhs. So the difference of 10,000 should be charged to P&L as impairment loss. Here, Ind AS 36, I will come back to that. Staff training cost, no asset can be recognized because there is no control of the company over the staff. When the staff leaves, the benefits of the training, whether they may leave or they may be also depart. What about your illustration number 6? Venus Limited, a private limited, Venus India Private Limited has acquired a software for internal use for a cost of 10 lakhs. 10 lakhs is the cost of acquisition eligible to be capitalized because you are buying a software with a separate legal right. It is identifiable 100% because you are acquiring it separately through a legal right. The amount payable for the software is 6 lakhs immediately and 4 lakhs in 1 year's time. In the other expenditure incurred were purchase tax of 1 lakhs, entry tax of 10%, recoverable later from tax department. Guys, purchase tax he did not give anything, but he is saying entry tax of 10% is recoverable later from the tax department. Recoverable taxes should not be included into the cost of the asset. So entry tax is not eligible to be capitalized, but purchase tax of 1 lakh is definitely eligible to be capitalized. Legal fee is 87,000, eligible to be capitalized. Consultancy for implementation 1,20,000, 100% eligible to be capitalized. Cost of capital is 10%. If you are wondering why did this fellow give me cost of capital, then you need to look back at the first paragraph again. The amount payable for the software is 6 lakhs immediately, 4 lakhs in 1 year time. So 1 year means it is deferred beyond normal credit terms. So that normal credit terms being deferred, if I give you a discount rate of 10%, you will have to identify what is the present value so that I will capitalize the asset. Clear? So let us try to calculate this. My purchase price is equal to 10 lakhs. This 10 lakhs, which is the purchase price, I am saying it can be broadly divided into two categories. Rupees 6 lakhs and 4 lakhs. 6 lakhs is paid immediately. Four lakhs deferred credit. What is the amount of deferred credit here? 1 year. The amount will be paid after 1 year. Whenever we are coming across this logic that the amount will be paid after 1 year, we will have to identify what is the present value. So under this, I am trying to identify what is my finance charges. Finance charge is equal to, calculate, 4 lakhs. Sorry, 1 second. Present value you calculate, finance charge you will get it as balancing figure. Present value without any deferred credit divided by 1.1 or into present value factor of 10% for 1 year. 1 divided by 1.1 is 0.909 into 4 lakhs. 33,63,636. So there is an evident amount of finance charge which is nothing but 36,363 or actually 364 guys, so that it actually matches. So what is the amount eligible to be capitalized? The amount eligible to be capitalized is this 6 lakhs paid immediately plus present value 3,63,636. These two amounts 9,63,636 is eligible to be capitalized. This finance charges which we got, I don't know if I'll capitalize this because I'll have to assess this as per IND AS 23. If it satisfies the definition of borrowing cost of qualifying asset under IND AS 23, then this finance charges are also eligible to be capitalized. But as of now, nothing is given. So leave this logic. Treat the finance charges as per IND AS 23 is a better statement to say. Okay. Treat the finance charges as per IND AS 23. The amount eligible to be capitalized is 9,63,636. However, there are some other costs also. So 9,63,636 plus what are the other costs which are eligible to be capitalized? Purchase tax of 1 lakh, so 10 lakhs 63,636 plus 87,000 rupee of consultancy charges. 9,63,636 plus 1 lakh being the purchase tax plus 87,000 being the consultancy charges plus 1,20,000 for implementation. Therefore, the total cost eligible to be capitalized is 12,70,636. 12,70,636 is the amount eligible to be capitalized. Your answer is absolutely correct. Guys, he did not write anything regarding the finance charge. Please make sure that you write. If you look at his answer stopped at 12,70,000. You will have to make sure that you are writing regarding the finance charges. Entry tax he wrote not to be considered as it is a refundable tax. He clearly made a statement, but unfortunately he did not write a statement regarding the point of your finance charges. Write that finance charges of 36,363 should be dealt as 364 have to be dealt under IND AS 23. If it satisfies the definition of qualifying asset, even such finance cost is also eligible to be capitalized. Clear? Make sure that you write that statement. We can give better answers than ICAI, provided you remember those paragraphs. When I see finance charges, I think I will get into mind my IND AS 23. Illustration number 7. On 31st March, Earth Limited paid 50 lakh rupee for 100% interest in Sun Limited. On the date, Sun Limited net assets had a fair value of 30 lakh rupees. In addition, Sun also held the following rights. Trademark of Grand, valued at 1,80,000 using discounted cash flow technique. That is a fair value of trademark. Sole distribution right of an electronic product. Future cash flows being discounted to the which are estimated to be future cash flows estimated to be 1,50,000 rupees per annum for the next 6 years. So the sole distribution right has not been identified. We will have to identify what is the fair value by applying the discount factors. 10% is the discount factor. 6th year annuity factor, that is PVAF, present value annuity factor for 10% is 4.6. Calculate goodwill and other intangible assets arising on acquisition. Very clear, guys. He's saying the purchase consideration paid is 50 lakhs. 30 lakhs belong to the fair value of the net asset. In addition to that, he's saying there are two intangible assets. One is a trademark valued at 1,80,000. Other one is sole distribution rights which should be valued, and the cash flows generated is 1,50,000 every year for the next 6 years, and the annuity factor is 4.36. So you will only recognize goodwill to the extent an intangible asset is not separately identifiable. These two assets, trademarks and sole distribution rights, since they are separately identifiable in the books of the acquirer, you have to make sure that the goodwill is reduced. We did look at this logic. I don't know how many of you remember this, but when we came up the logic of separate acquisition, we did look at this logic. I'll show you where we discuss this. Absolutely right here. So if there is an intangible asset being recognized, then there is an increase in the fair value of the net assets. Automatically, the value of the goodwill will reduce. How do you calculate goodwill? Purchase consideration minus fair value of net assets acquired, and this formula is given as per IND AS 103. This is my IND AS 103 paragraph. Application. Right? So let's try to identify. Goodwill is equal to purchase consideration minus fair value of net assets acquired. Let's go on. You know what is the purchase consideration, right? What is the purchase consideration given in the question? 50 lakhs. What is the fair value of net assets acquired? 30 lakhs he already gave, but apart from this 30 lakhs, I also have two more assets. One is a trademark, other one is a distribution right which I have to add. So I'll have to add it. So I'm leaving certain space. So I'm talking about, there's one asset which is already known to us. That is a trademark. The trademark is valued at 1,80,000. We also have to add the amount of distribution right to the cost. So find out what is a distribution right. Sole distribution rights is equal to how much is the amount that you're going to get every year? Every year I'm going to get 1,50,000. Like that I'll get for 6 years. 1,50,000 into present value annuity factor 10% for 6 years. He gave me this 10% for 6 years. The value he gave me 4.36. 1,50,000 into 4.36. 4.36, if we would have considered, he would have struck off your answer saying that you're only considering 2 decimals. But since he gave it in the question, I can use it. Otherwise, I would have taken 4 decimals. 6,54,000. 4,000 plus 1,80,000 being your trademark plus 30 lakh being your other assets minus 50 lakhs, which is the amount of purchase consideration. Therefore, the goodwill resulting figure is rupee 11 lakh. Actually, if you observe, 30 lakhs is the value of net assets, 50 lakh is the purchase consideration, goodwill is 20 lakhs. But since there are certain intangible assets which can be identified separately, the value of the fair value of net assets will go up. Automatically, the goodwill and on purchase on business acquisition or business combination will come down. So instead of 20 lakhs, you are only reporting a goodwill of 11,66,000. According to your business combination logic, as far as intangible assets under Ind AS 38 is concerned, an intangible asset can be recognized if it can be separated from the value of goodwill. So that means I have separated the value of 1,80,000. I also separated the value of 6,54,000. If I cannot separate these values, then they will be included in the value of goodwill. Automatically, the goodwill would have been 20 lakhs. Clear? 11,66,000 is your answer. Appropriately correct. Illustration number 8. Sun Limited acquired a software from Earth Limited in exchange of a telecom license. The telecom license is carried at 5 lakhs in the books of Sun. The software is carried at 10,000 rupees in the books of Earth. Okay. Advice: in following situations, what should be booked in the books of Sun Limited and Earth Limited? Fair value of the software is 520. Fair value of the license is 500. Fair value of software is not measurable. However, similar telecom license can be transacted for 4,90,000. Neither the fair value of software nor the telecom license can be reliably measured. 3 different cases, guys. First one, fair value of software is 5,20,000. Fair value of telecom license is 5 lakh. That means both fair values are clearly visible. Second one, where the fair value of the software is not measurable. Okay. However, the similar transaction, a license can be, telecom license is transacted at 490. Neither the fair value of the software nor telecom license can be measured reliably. So both all 3 cases will have to pass entries. First case, think about who is transacting with whom. Sun acquired software in exchange of their telecom license. So for Sun, first entry, software you have acquired has a fair value of 520. The fair value of telecom license is 500. Guys, when both fair values are clearly visible, then you can record it as per their fair values, or you can take the fair value of the asset given up. What is the fair value of the asset given up? Telecom license 500. So therefore, you could have written the entry as software account debit to telecom license 500 or 5 lakhs. However, since the fair value of the software is also clearly visible, he is taking both of them. So he has considered 520 to telecom license 500 to profit on exchange 20. Answer is absolutely fine. Even if you would have written software account debit to telecom license 5 lakhs. Clear? All entries are written in thousands, guys. So if you would have gone as per the logic of the standard, you would have said it should be the fair value of the asset given up. The asset given up is 5 lakhs. So therefore, software account debit to telecom license 5 lakhs is an appropriate answer. But since you know even the fair value of the software is considered in writing the entry, answer is not wrong at all. It is not wrong. It is up to you. What would have the entry? What would be the entry when you are recording in the books of the other company, Earth Limited? The carrying value of the telecom license is 5 lakhs, while the software is only carried at 10,000 in the books of Earth Limited. So Earth Limited has acquired the telecom license. Telecom license account debit to your software. So what is the telecom license account debit? Fair value of telecom license being 5 lakhs. To software. What is the amount of software? The software is shown in the books only at 10,000. So 5 lakhs account debit, telecom license. To software 10,000. To profit of exchange of asset is 4,90,000. Here, move on to the second thing. Software fair value is not measurable. However, similar telecom license is transacted by another company at 490. So therefore, I'll have to measure the software at the fair value of the telecom license, which is 490. Now record the entry in the books of Sun Limited. I acquired software account debit to telecom license. Software account debit, fair value of telecom license should be considered as the fair value of software, 490 or 4,90,000. To telecom license, carrying value in my books is 5 lakhs. Therefore, I incurred a loss of exchange for 10,000 rupees. What about the other company, Earth Limited? Telecom license account debit to software. Telecom license account debit 490. To software 10. To profit on exchange 480. Neither of those fair values are available. In such cases, what do? Identify the asset acquired at the carrying value of the asset given up. Therefore, first entry in the books of Sun Limited, I would have written the entry as software account debit to telecom license 5 lakhs. And in Earth Limited, I would have written the entry as telecom license to software 10,000, which is the carrying value in the books of Earth Limited. Absolutely right. All three entries. The first entry, like I told you for Sun Limited, you could have very well written it as software account debit to telecom license for 500 also. Answer would be absolutely right. Let's look at the next illustration. Venus is preparing its account for the year ended 31st March. He is unsure on how to treat the following items. So you will have to give the treatment item by item, guys. Each item separately you have to specify what is the accounting treatment. The company has completed a big marketing and advertisement campaign costing 2,40,000. Now what is your take on this? Marketing and advertisement campaign of 2,40,000 eligible to be capitalized as per the books of accounts ending on 31st March or no? Answer is no, because advertisement campaign is not separately identifiable. Since it cannot be identified as a separate asset, you cannot capitalize this cost of 2,40,000. This 2,40,000 should be charged off to P&L. Future economic benefits are also not probable to arise from these advertisement campaigns. The finance director had an authorization that this campaign would create 5 lakh rupees as additional profit for the next 3 years. Irrespective of that, my treatment would still remain the same, even though he is contending that there could be some additional profit due to advertisement campaign, not an identifiable asset, not supposed to be capitalized, entire 2,40,000 charged to P&L. The new product was developed during the year. The expenditure totaled to 1,50,000, for which 1 lakh was incurred prior to 30th September, the date on which it became clear that the product is technically viable. So until 30th September, whatever expenditure was incurred is called as an expenditure relating to research phase. Such expenditure relating to research phase, when the outcome is uncertain, future economic benefits are not probable, such amount of expenditure should be charged off to P&L. So the entire 1 lakh rupee of expenditure incurred prior to the date on which it became clearly visible that it was technically viable has to be charged off to P&L. So 1 lakh charged to P&L. The balance 50,000 out of the total 1,50,000 is incurred after the product became technically viable. So therefore, it is eligible to be capitalized as development expenditure for 50,000. The product will be launched in the next 4 months and its recoverable amount is estimated to be 70,000. Development expenditure capitalized is 50,000. Recoverable amount is 70,000. Since recoverable amount is greater, there is no impairment to be charged as per IND AS 36. The development expenditure should be capitalized for 50,000 and will be continued to be reported as 50,000 only. No impairment is supposed to be charged. The staff participated in a training program which cost 3 lakhs to the company. The training organization has made a presentation to the directors of Baxter outlining the incremental profits over the next 12 months would be 5 lakhs. Any marketing fellow will do the same thing. If I am asking you to incur 3 lakh rupees of expenditure as staff training, I would obviously tell you that the benefit that you will derive from such staff training is much more than 3 lakh. Same thing he did. He incurred 3 lakh rupees of staff training cost, but the company which was giving the training is telling them that they will get a benefit of 5 lakhs over the next 12 months. Cannot be considered. Staff training cost is not to be recognized as a separate intangible asset because the enterprise lacks control. Clear? How should these amounts be appearing? Marketing advertisement campaign, charge to P&L. Research and development of 1,50,000, 1 lakh pertains to research, charge to P&L. 50,000 pertains to development, capitalized. Recoverable amount is more than the carrying value, no impairment. Staff training cost, it is not possible for the enterprise to exercise control over this intangible asset generated. Therefore, it cannot be capitalized. It has to be charged off to P&L. Clear? Illustration 10. Expenditure incurred on the new production process for the year 21-22. 1st April to 30th December 2,700. Jan to March was 900. The production process met the intangible asset criteria, recognition criteria for development on 1st Jan. So all expenditure incurred until that date is charged to P&L. So 2,700 has to be recognized into the P&L as the expenditure relates to research phase and not the development of the asset. The amount estimated to be recovered from this process is 1,000. How much is eligible to be capitalized? 900 as development phase incurred after it meets the recognition criteria. So therefore from 1st Jan to 31st March 900 rupees of cost is eligible to be capitalized as intangible asset. The recoverable value of this asset is 1,000. No impairment is supposed to be recognized. Impairment will only come in when the recoverable amount is less than carrying value. Carrying value 900, recoverable amount 1,000. Therefore, 100% it is greater than the recoverable value. Sorry, it is the recoverable amount is greater than the carrying value. No impairment as per IND AS 36. What should be the carrying value on 31st March? Carrying value will be 900 only. And the charge to P&L for the year 2011-12, sorry, 21-22. 2021-22, the amount to be charged to P&L is the expenditure relating to research phase, 2,700. Clear? The expenditure incurred for the next year, that is 22-23, is 6,000. As on 31st March 2023, the amount estimated to be recovered from the process is only 5,000. Guys, you've already capitalized in 31st March 2022, 900. Next year, he incurred a further cost of 6,000. Therefore, which is also eligible to be capitalized because the recognition criteria is met. So today, after capitalizing the subsequent cost of 6,000, what is the carrying value of the asset? 900 last year, 6,000 current year. Total cost capitalized is 6,900. But on the balance sheet date, he is saying that the value of the recoverable value from this asset is only 5,000. Therefore, the amount to be charged to P&L is 1,900. That is the difference between the carrying value and recoverable amount. IND AS 36, this 1,900 will be charged as impairment loss. What is the carrying value of the asset at the end of 31st March 2023? It is 5,000 rupees only. Carrying value of 900, recoverable value being higher, no impairment. Carrying value at the end of 2023 will be 5,000 rupees and the amount charged to P&L. I think the answer is not complete there. Kindly add the answer, guys. Amount capitalized to the cost of the asset is 6,900. 900 of last year plus 6,000 of current year 2022-23. From 6,900, reduce the recoverable amount of 5,000 rupees. 1,900 rupees is the impairment loss which should be charged to P&L. Clear? Am I clear in this aspect? The answer of 1,900 is not there. Please make sure that you include it. 1,900 rupees is impairment loss for the year 2022-23, which should be charged off to P&L. Just a second, guys. Was this illustration number 10 which we solved? Yeah. Next one is in illustration 11. Saturn acquired an intangible asset on 31st March 2021 for 1 lakh. The asset was revalued at 1,20,000 on 31st March 2022. What should be the entry that you pass? Subsequent valuation or subsequent measurement is that revaluation model. So revaluation model, increase in the carrying value of the asset. How do you recognize? Initial upward revaluation credited to revaluation surplus. So in intangible asset account debit 20,000 to revaluation surplus 20,000. That will be the entry to be recorded on 31st March 22. It was revalued to 85,000 on 31st March 23. 1,20,000 became 85,000, downward revaluation of 35,000. But this asset was upward revalued earlier by 20,000, revaluation surplus existing. So therefore, how do you record the entry? I'll recognize the entry as revaluation surplus account debit 20,000. Whatever you credited earlier, you reduce it because the downward revaluation is much more than your revaluation surplus. The extra downward revaluation of 15,000 should be charged off to P&L. Correct? So answer is revaluation surplus account debit 20,000, P&L account debit 15,000 to intangible asset 35,000. So the set of two entries that we have to record should go like this. On 31st March 2022, I'll record the entry as intangible asset account debit to revaluation surplus. How much is the amount? The amount is 20,000. Subsequent year, there is a downward revaluation by 35,000. So on 31st of March 2023, it was downward revalued. So reduce the intangible asset by 35,000. How do I recognize this 35,000? First, debit your revaluation surplus. Debit revaluation surplus. To the extent it is available, 20,000. What about the balance 15,000? The balance 15,000, I will debit it to P&L. I'll debit the balance 15,000 to P&L because the amount of downward revaluation is much more than the revaluation surplus already existing in your books of accounts. Clear? What about the next entry? Jupiter has acquired an intangible asset on 31st March 2021 for 1 lakh. The asset was revalued to 85,000 in 31st March 2022 and 1,05,000 on 31st March 2023. Assuming that the financial of year end for both companies is 31st March, using revaluation model, how should these transactions be recorded? So another company, Jupiter Limited, is there, where the intangible asset acquired was for the same 31st March as 1 lakh, but the value of the asset was downward revalued initially to 85,000 and the balance was basically and 1,05,000 upward revalued subsequently in the year 31st March 2023. How do you record this transaction then? Come back to recording the entries in the books of Saturn. March 22. First, downward revaluation by 15,000. Charge it off to P&L. Initial downward revaluation debited to P&L. To intangible asset. Downward revaluation 15,000. Charge off to P&L. But subsequently, in the next year, that is on 31st of March 2023, it was upward revalued to 1,05,000. If it was upward revalued to 1,05,000, the increase in the value of the asset is 20,000. How do you recognize this upward revaluation? We will have to make sure that we are crediting the P&L to the extent it was debited earlier. Out of 20,000 increase, 15,000 was already debited to P&L earlier. Now you credit it to P&L. So first, intangible asset account debit. How much is the increase in the value of the asset? 20,000. Became 1,05,000. To P&L to the extent it was credited earlier. Balance credited to revaluation surplus. Yes. So guys, these entries are similar to what we have seen under property, plant and equipment in AS 16. They are nothing new to us. Intangible asset is also applying the same subsequent measurement under cost approach or revaluation approach. So these are the entries supposed to be recognized under revaluation approach, which we have discussed in depth even under Ind AS 16 as well. So I'm just giving you a recap of the entries that are supposed to be written so that you'll have a better understanding of that. Clear? Let's continue then. Done with illustration number 11. I think we missed illustration number 12 somewhere. I did not find your illustration number 12, guys. Let us go with illustration number 13 itself. X purchased a patent right on 1st April for 3 lakhs. Has a legal life of 15 years. However, due to the competitive nature of the product, the management estimates that a useful life of only 5 years. Here, so had a legal life of 15 years, but the useful life is only estimated as 5 years. What did you say? Your useful life should not exceed your legal life. But here legal life is 15, so useful life can very well be 5 years. Straight line basis of amortization is determined by the management to be the best method. So over 5 years, 3 lakh rupee of patent. If I depreciate on a straight line basis, the amount of depreciation should be 60,000. No use of calculator. 3 lakh divided by 5 also, if you use calculator, then no one can help you. Okay. 3 lakh divided by 5 is 60,000 to be charged as to P&L as amortization. Straight line amortization is determined as the appropriate method. On 1st April 2022, that is next year, management is uncertain that the process can actually be made economically feasible and decides to write down the patent to its estimated market value of 1,50,000 and to amortize it only over the next 2 years. So on 1st April, what is he doing? He is reducing the value of the asset. He is degrading the value of the asset. At the end of the year, what was the carrying value? 3 lakhs minus 60,000. That means the carrying value of the asset was 2,40,000. That asset which had a carrying value of 2,40,000 is now written down to its market value of 1,50,000. That means a reduction of 90,000 which should also be charged to P&L. But on that day, it decides to amortize it only for the next 2 years. If you are amortizing it only for the next 2 years, per year amortization is 75,000. On 1st April 2023, having perfected the related production process, the asset is now being appraised to a value of 3 lakhs. 1,50,000 was the value of the asset after it was downward revalued on 1st April 2022. In the year ended 22-23, they would have again depreciated the asset by 75,000. So the balance written down value is 75,000, now is increased to 3 lakhs. That means increase in the value of the asset is 2,25,000. Now he is asking you to determine what is the value of the asset. Now it has a 4 years of useful life. 3 lakhs divided by 4 is 75,000 to be depreciated every year. Now what should be the value of the asset at the end of each year? At the end of first year, that is for the end of 2021-22, the amount of the asset or the value of the asset is 2,60,000. How 2,60,000? 3 lakhs minus depreciation over 5 years on a straight line method is 60,000. So 2,40,000 is the written down value. But next year, it has been written down to 1,50,000. At the beginning of the next year itself, you have written down the value of the asset to 1,50,000, charging 90,000 rupees to P&L as downward revaluation. And has decided to amortize it only over 2 years. For the next year 22-23, the depreciation is 75,000. Therefore, the carrying value of the asset is 75,000 at the end of 31st March 2023. But in 31st March 2000, on 1st April 2023, immediately next year, they have again increased the value of the asset to 3 lakhs. Therefore, upward revaluation of 2,25,000. 90,000 I will credit it to P&L to the extent it was debited earlier. The balance amount above 90,000, which is nothing but 1,35,000, should be transferred to revaluation surplus. Clear? Now you are saying that the value of the asset is 3 lakhs at the beginning of the year, depreciated over 4 years. So 3 lakh divided by 4, the depreciation per annum is 75,000. So the end of 2020 so 31st March 2024, the value of the asset will be 3 lakh minus 75, 2,25,000. Take at the end of first year, it is 2,40,000 and further depreciation should be 75,000 every year after the next year downward revaluation. Right? 90,000 rupees is charged to P&L. This is wrong, guys. This is 31st March 2023. This is 22, this is 23 and this is 24. Please be careful. Written down value of the asset is 75,000. Next year, there is an upward revaluation on the value of the asset, became 3 lakhs. 1,35,000 will be transferred to revaluation surplus. And after the depreciation, the value of the asset will be, after depreciation, the value of the asset of 75,000 will be 2,25,000. Move on to the next one. X, a pharmaceutical company, seeks your opinion in respect of the accounting transactions. They have acquired 4 years license to manufacture a specialist drug. Serum Institute acquired the license to manufacture Covishield from AstraZeneca. Oxford AstraZeneca is the trust which has actually developed a vaccine Serum is actually utilizing the license. Same way, X has acquired the license for the manufacture of a specialized drug. The cost of acquiring the license is 1 crore at the start of the year. Production commenced immediately. Also, the purchased another company at the start of the year. As a part of acquisition, they acquired a brand which had a fair value of 3 lakhs based on sale revenue. The life of the brand is estimated to be 15 years. They spent 1 crore on an advertisement campaign during the first 6 months. Then subsequent sales have shown significant improvement and it is expected to continue for 3 years. It also commenced developing a new drug, drug A. The project cost would be 10 lakhs. Clinical trials have been approved successful and such cost is expected to generate revenue for the next 5 years. Cost incurred until 31st March is 5 crores. Balance cost incurred during the financial year 21-22 is another 5 crores. Here, it was also commenced developing drug B, has incurred 50 lakh towards the research expenditure till 31st March. The technical feasibility has not been established yet. How will the above transactions be accounted for in the books of X Pharmaceutical Limited? X Limited is seeking an opinion for the transaction. First one, license to manufacture a drug has been purchased at a price of 1 crore and it is expecting to have a license for 4 years. Therefore, production being commenced immediately, this 1 crore should be capitalized as a license acquisition cost as a separate intangible asset acquired through a legal right. It should be amortized to P&L over the useful life and such useful life should not be more than 4 years. Let us say it is equal to 4 years in this case. Therefore, I should be charging a depreciation of 25 lakhs every year on this license cost acquired for a specialized drug. Clear? First part. Second one. They purchased another company as a part of acquisition. They acquired a brand which had a fair value of 3 lakhs based on sale value. The brand is estimated to have a useful life of 15 years. Guys, they have acquired a brand. Can I capitalize this? Is it an identifiable intangible asset is the question. A brand cannot be considered as an identifiable asset because it is not possible to have a brand unless and until it is along with other manufacturing facility. If you have identified brand as a separate asset, then your answer is right. 20 lakhs depreciation every year, useful life is 15 years, everything is fine. But the question of whether I can capitalize this cost of brand acquired at a fair value of 3 crores or not. The answer is brand is not a separately identifiable asset. Since the definition and the recognition criteria is not met under Ind AS 38, brand cannot be identified as a separate intangible asset. Then what should I do? I'll have to include this fair value of the brand into the value of goodwill at the time of acquisition of the company itself. Clear? They spent 1 lakh on advertisement campaign. Advertisement campaign is not an identifiable asset. Straightforward, charge it off to P&L. It has commenced development of a new drug A. The project cost is 10 crores and the clinical trial provided successful. Such drug is estimated to incur an additional revenue for the next 5 years. The cost incurred until 31st March is 2021 is 5 lakhs. Next year is 5 crores and next year is 5 crores. When is the technical feasibility met? I'm not able to understand. Let's look at drug B. Drug B charged to P&L immediately because technical feasibility is not established only. Let's try to see what the answer is. It would recognize the drug license as a separate intangible asset which you have acquired for 1 crore. Because, is it 1 crore? First one, drug license acquired for specialized drug. Yes, 1 crore, 4 years. Because it is an external purchase, separately identifiable, the drug shall be recorded at 1 crore drug license cost, should be recognized in P&L over 4 years, depreciation being charged of 25 lakh rupees every year. It should be recognized brand as an intangible asset because it is purchased, a part of a purchase of acquisition and it is separately identifiable. He has considered it as separately identifiable, guys, but according to me, brand cannot be separately identified. Brand should be a part of goodwill only. For him, he said he has actually written it as separately identifiable and he recorded the brand as a separate asset, charged the amortization over 15 years at 20 lakhs rupees per year. Advertisement expenditure 1 lakh should be charged off. Development expenditure for 2021-22 should be capitalized. So the value of 5 crores is eligible to be capitalized on drug A. Next year, another 5 crores to be capitalized. Finally, the total cost of the drug is 10 crores. Research expenditure of 50,000 rupees on drug B should be expensed off because the technical feasibility has not been met. And that will bring us to the end of discussion. I still have a different answer regarding drug, guys. I will stick to my answer. I am not in line with IND AS, the ICAI answer which is given. For me, brand is something which is very difficult to identify. Identification of brand is not possible for me, though it is an acquired brand. Even though it is an acquired brand, self-praised brand, forget about it. That is, concept itself does not arise because cost cannot be measured reliably. Here, it is an acquired brand, but I believe that the brand should be included into the value of goodwill and not recognized as a separate identifiable asset. So that will bring us to the end of illustrations, guys, that we have solved under IND AS 38. That is only for helping your better understanding of the standard. From now on, we will have to look at workbook problems and also compendium of solved illustrations, which includes RTPs, your model test papers, your past exam papers, everything also included.